The stock market does not need the world to become better in order to go up violently. It only needs enough traders to be trapped on the wrong side at the wrong time. That is where I want to begin, because the public keeps asking the wrong question. They ask, if war is bad, why did stocks go up? That sounds sensible. It is also a poor way to understand the modern market. The better question is much harder and much more useful. What exactly was the market built to do in that moment? Was it actually weighing the future of the global economy with calm human judgment, or was it a giant machine made of leverage? Short exposure, passive flows, systematic trend models, and options dealer hedging, all reacting to each other in real time after one headline hit the tape. That is the real issue. Not peace, not optimism, not a clean relief rally. The deeper truth is that the market most people still imagine no longer exists in the form they think it does. The old market, the one run mainly by patient humans reading financial statements, arguing over valuation, and deciding what businesses were truly worth, has not vanished completely. But it is no longer the dominant force in the way it once was. The market that dominates today is much more mechanical, much more reactive, and much less interested in whether a headline is philosophically true than in how that headline interacts with positioning already embedded in the system. That is what this whole story is really about. The file you gave me says it directly, and it is the most valuable line in the entire piece. This was not a relief rally in the clean sense that financial television wanted to sell. It was a short squeeze followed by a systematic flip, followed by options-related dealer hedging, all happening in a market structure that is now defined far more by feedback loops than by clean fundamental interpretation. That is the real mechanism. Faithfulosite Faturn 62, File 0 Fay. Once you understand that, the whole event stops looking irrational. It starts looking modern. And that is much more unsettling, because once you admit that this is what the market has become, you can no longer comfort yourself with the old folk stories. You can no longer say, stocks rallied because peace broke out, when the ceasefire itself was already visibly unstable. You can no longer say, markets are just celebrating certainty, when shipping through the key choke point remained impaired, and the geopolitical facts on the ground were still messy. You cannot even say, with a straight face, that prices must always be reflecting some superior consensus about reality. Sometimes they are, often enough now, they are reflecting the violent consequences of how the market was positioned before the headline arrived. That is a completely different thing. And if you do not understand that difference, you will spend your investing life being emotionally whipsawed by moves that seem dishonest. But they are not dishonest. They are structural. I have always believed investors suffer most when they confuse morality with mechanism. They look at the world and say, this should not happen. That phrase is the beginning of a lot of bad financial behavior. Markets should not go up if war is bad. Markets should not rip to record highs if the ceasefire is falling apart. Markets should not shrug off oil risk if the physical flow through Hormuz is still impaired. Maybe in some older and slower market one could hold those instincts a little longer. But in today's market, a great many violent moves have more to do with the plumbing than with the morality of the headlines. That is why I want to talk about the plumbing, because the plumbing is the story. Let us start with what Wall Street looked like before the ceasefire announcement. The file makes this clear, and it matters. The market had already suffered a serious drawdown. Hedge funds had become deeply bearish. Selling had reached extreme levels. Gross leverage was high. Short exposure to broad macro ETFs like SPY and QQ was near the highest level since the pandemic. Commodity analysts were warning that if the oil shock fully hit, recession would be too gentle a word for what could follow. In other words, the market was not neutrally positioned. It was coiled. That is the setup people keep missing. A market does not need to believe in paradise to rally hard. It only needs too many people betting on the wrong immediate path. That is what a short squeeze really is, not some meme, stock curiosity. Not some internet phenomenon. It is a very old and very brutal market event. You borrow shares, sell them, and hope to buy them back lower. Later, fine. But if the market rises instead, your losses begin growing. Eventually, those losses become intolerable to you or to the people financing you. Then you are not short because you choose to remain short. You are short because you are trapped until you buy those shares back. That buyback is not a fresh bullish opinion. It is forced demand. And when many players must create that demand at once, price can move far more than a calm human observer would consider fair. That is the first domino. The file is right to say the market had become deeply bearish under the surface. That matters because the violence of a squeeze is usually a function of how crowded the bet had become before the reversal started. If enough funds are leaning in the same direction, then the first upward break is not merely a rise. It is a pressure wave. One player starts covering, then another, then another. Brokers call, risk managers intervene. The machine that was built to profit from fear begins converting itself into buy pressure. Faithfulosite Faturn 62 File 0 Fay. That is why the market ripped. Not because every macro risk suddenly disappeared, because fear had become overowned. Now let us go to the second domino, because this is where the market stops being mostly human and starts becoming obviously algorithmic. The file brings in the CTAs, the commodity trading advisors and trend following systematic funds. Good. They belong at the center of the explanation because their role in the modern market is chronically underestimated by people who still think markets are primarily thoughtful aggregators of information. CTAs do not care about your narrative comfort. They do not sit around asking whether the ceasefire is durable, whether Iran's next move makes sense, or whether equity valuations already reflected too much optimism. They follow models, they follow thresholds, they follow momentum. When price is moving down, their rules lean them short or defensive. When price reverses hard enough through the relevant triggers, their rules flip. That is not judgment, that is reaction. And because so much capital now sits inside such reactions, a rally born from one source of forced buying can trigger the second source automatically. That is what the file describes. The short squeeze began. The market crossed levels. The CTAs flipped. Suddenly another wave of buying hit. And again, this buying was not some clean, thoughtful endorsement of peace. It was rules-based capital doing what rules. Base capital does when price moves enough. This matters enormously because it means the rally is no longer simply the market thinking the war got better. The rally is now the market mechanically responding to itself, and that is one of the deepest truths of modern price behavior. People still speak about markets as though they were giant intelligence engines. Sometimes they are, but often now they behave more like giant reflex systems. One trigger activates one type of participant, whose buying changes price enough to activate another participant, whose buying changes price enough to activate a third. That is not wisdom, that is cascade. The file is right that Goldman's estimated CTA flows were large and the realized buying even larger. Again, the precise dollar count matters less to me than the structural point. The market had become one of those environments where price itself was the most powerful catalyst. Once enough forced buying started, the move became self-validating for the next category of reactive players. That is why modern rallies can look so absurdly powerful compared to the actual news that supposedly caused them. Fay turn. 62 file 0 Fay. But we still are not done, because then comes the third domino, the options market. This is where the public finally loses the plot entirely, because the options market is both central and invisible. Many people still think of options as a side casino. That is childish. The options market now sits so close to the center of equity price formation that you cannot understand major short-term moves without understanding dealer hedging. If customers buy calls aggressively, the dealers who sold those calls often need to buy stock to hedge. If the market is in a negative gamma regime, that hedging can become procyclical. Price goes up, dealers buy more, their buying pushes price higher, higher price requires more hedging. The loop feeds itself. That is why some rallies now feel less like upward motion and more like ignition. The file is correct to identify this as the third stage of the move. Once the squeeze and the systematic flip got things going, the options structure amplified it. And again, notice what that means. By the time you reach this third stage, the move has become even less about the real-world event and even more about how the market's own internal architecture reacts when price moves through a stress system. This is not an academic point. It changes how an investor should interpret everything. If you think every dramatic move is the market thoughtfully repricing reality, then you will draw false conclusions from short-term price behavior. You will say, the market must know something reassuring, maybe. Or maybe the market is simply digesting its own leverage and hedging structure. Those are radically different explanations. One suggests the world got safer. The other suggests the machine got unstable. This is why I think the word rally is often too soft for what we are seeing. A rally sounds elective. This was closer to release of trapped positioning, release of trend rules, release of dealer hedging pressure. That is why it moves so hard. Now, let us broaden the frame, because the file's larger contribution is not just explaining one event. It is explaining why these events keep happening. This is where passive investing enters, and it is where many people become uncomfortable, because passive investing is both extremely useful and structurally distorting. Let me be very clear. I am not against passive funds. Quite the opposite. They are one of the great democratizing tools in finance. They are cheap, they are simple, they are often exactly the right vehicle for ordinary people building long-term wealth. But their scale has changed the market. That is not a moral criticism, it is a structural observation. A passive fund does not ask whether a company is underpriced. It allocates, it buys because the company is in the index. And if the index is market cap weighted, the largest companies receive the biggest flows by default. That means the public's retirement contributions, automatic payroll plans, and broad savings behavior increasingly create demand through rules rather than through fresh valuation analysis. The file correctly points out how concentrated this has become, with the largest companies taking an enormous share of the index. That means more and more buying pressure is simply allocation pressure, not active conviction. Faithful Asite Fe turn 62 file 0 Fe. This matters because markets used to be more dominated by humans making discretionary judgments stock by stock. Humans are imperfect, yes, but at least they are interpretable. Today, a much larger part of the market is rule-driven. Retirement contributions flow in, index funds buy according to weights. The biggest companies get the biggest incremental allocations. That does not mean price no longer matters. It means the route by which money meets price has changed. And once the route changes, the behavior changes. This is why the old investor's intuition about what should happen becomes less dependable. Then there is leverage, the giant multi-strategy hedge fund complexes the file mentions are not leisurely stock pickers. They are large, highly optimized, risk-managed machines. If they hit certain drawdown thresholds, they do not gather in a room and debate philosophy. They reduce, they cover, they hedge, they react. That makes the market faster, less forgiving, and much more likely to produce reflexive cascades. One can dislike that fact, fine. But disliking it does not help. Understanding it does. And understanding it leads to a conclusion many people do not want to hear. The market is no longer mostly a place where people calmly discover value. It is increasingly a place where people and systems respond to other people and systems responding. That is a very different ecosystem. It is a feedback loop. And once feedback loops dominate, headlines become less like causes and more like sparks, landing in dry grass. The real flammability was already there. That is why I think the file is so strong when it says the headlines are increasingly just the narratives used to rationalize what the machine already did. That sentence is worth more than most viewers will realize, because if it is true, and I believe it often is, then financial media is not mainly explaining price anymore. It is often decorating price after the fact with the simplest available moral story. Stocks cheer peace. Markets love certainty. Investors embrace soft landing. Hopes. Fine. Sometimes those phrases are directionally acceptable, but too often they are wrappers around what was really a plumbing event. This is not new in a total sense. Markets have always had squeezes, feedback effects, and emotional overshoots. What is new is the scale. Passive money is enormous. Same-day options are enormous. Dealer hedging matters more. Systematic funds are larger. Leverage remains pervasive. That means the modern market can produce dramatically outsized, short-term moves without a correspondingly large change in the actual state of the world. That is what ordinary investors must now learn to live with. And this is where the philosophical consequences begin. If the market can move violently higher while the geopolitical backdrop remains fragile, then short-term price action becomes much less trustworthy as a truth signal. That is uncomfortable. People like to think the market knows. It sounds reassuring. Sometimes the market knows something. Sometimes the market is simply forced. Those are not the same thing. This is why I think one of the most useful mental upgrades an investor can make now is to separate long-term ownership from short-term interpretation. Long-term productive assets still matter. Businesses still matter. Earnings still matter. Valuation still matters over time. But short-term price behavior is increasingly contaminated, or at least heavily shaped, by market structure. So the wise investor learns not to overread every vertical move or every collapse as a clean statement about reality. That is the emotional discipline this era requires. Do not confuse a squeeze with truth. Do not confuse a collapse with destiny. Ask what the system looked like before the move. That is the better question. Were too many funds crowded short? Was dealer gamma unstable? Were systematic players near trigger levels? Was passive concentration magnifying flows into a narrow leadership group? If those conditions existed, then the move may tell you far more about the machine than about the world. And that is a very useful distinction, because the investor who understands that becomes slower to panic and slower to celebrate for the wrong reasons. He becomes less likely to sell because a rally makes no sense, and less likely to buy because he mistakes a squeeze for a durable improvement in the underlying environment. He begins to respect the possibility that the market is not offering a verdict. It is just unwinding itself. That is a much healthier mindset. Now let me say something uncomfortable. This does not make the market worse for long-term investing, but it does make the experience of long-term investing psychologically harder, because when price becomes less intuitive, human beings become more tempted to overreact. They want to explain every move. They want every move to have a clean moral cause. They want the world to be legible. Modern market structure keeps frustrating that desire. It keeps producing moves that are partly real, partly mechanical, partly narrative, and partly pure reflex. That is exhausting if you insist on reading every day as though it contains a fully coherent message. It is much less exhausting if you accept that the market has become a more chaotic machine and build your approach around that fact. This is why I think the file's central insight is larger than the specific ceasefire rally. The real lesson is that the market now behaves like a giant interaction among passive flows, leveraged funds, rules, base traders, and options dealers, with human narrative often arriving late and functioning, mostly as explanation theater, that is the world investors now inhabit. Fe filicite, fe turn 62 file 0 fe, and once you admit that, a lot of old arguments start sounding naive. Why are stocks up if the fundamentals are still bad? Because price can move violently for structural reasons before the fundamentals genuinely improve. Why did the market ignore the ongoing war? Because the market was not first responding to the war's full reality. It was responding to how traders were positioned for the war. Why did the move feel so exaggerated? Because in a feedback-driven market, exaggeration is often the mechanism, not the mistake. That is the right answer. And if I had to compress the entire story into one sentence, I would say this: stocks did not surge because war became good or peace became real, but because modern markets are now so dominated by leverage, positioning, passive flows, systematic triggers, and dealer hedging that one headline can ignite a mechanical buying chain far more powerful than the underlying reality alone would justify. That is the sentence I trust, because it explains the rally without requiring me to pretend the world suddenly became safe, and it explains the market without requiring me to pretend. Markets are still mainly run by thoughtful humans expressing patient judgment one stock at a time. The market has changed, the machinery matters more, the headlines matter less than people think. And until investors learn to read the machine, they will keep mistaking violent mechanical reactions for genuine collective wisdom. That is a costly mistake. I would rather not make it.